Hi, everybody. Welcome to the Thursday Financial Thing live stream. Live here from very, very sunny and balmy Orlando, Florida, where it's currently 32 degrees. It's very warm. Hope you're having a wonderful week. We had a great stream last week with Natalie Weeks from Cufflink. She was the head of collections. If you haven't seen that video, go back in the archives. It's right now on the Financial Thing channel under the live tab. If you go to the live tab on the playlist, you'll see the chat I had with Natalie. I think it went really well. I was pretty happy with that. Actually, very happy. And this week we were supposed to have Michael Bristow from Crowd Property. Mike emailed me a couple of days ago and asked if we could reschedule to next Thursday. He got a little confused. He thought for some reason it was on a Wednesday, which, Mike, you should know better. It's always been a Thursday, even though last week it was a Friday. So, yeah, I guess it could be confusing. But anyway, Mike will be here next Thursday at 7:30 p.m. UK time. Mike Bristow is the CEO of Crowd Property, so we'll be talking major peer-to-peer lending topics with him. Put it on your calendar. It's already on the YouTube channel there. You can see it scheduled for next week. So Mike will be here then. Excited about that. Have a lot to talk about with Crowd Property. You want to know what's going on over there. It's been over a year since Mike was on the stream. Super excited. So what are we going to talk about this week? Well, we're going to talk about a little bit of peer-to-peer lending. And one thing I wanted to mention too is somebody had asked me on an email last week, why do I cover other things aside of peer-to-peer lending? Well, when I first started the stream, and hold on one second. I got to put the sponsored by Cufflink sign up there because we are sponsored by Cufflink. Actually, we'll get to that in a minute. Anyway, somebody said, why do I cover other things aside of peer-to-peer lending? And here's a reason why. Number one, I've always been interested in peer-to-peer lending and other forms of investing and just general financial things, hence the term financial thing. It's not peer-to-peer lending thing, it's financial thing. So, I do choose to kind of discuss other topics and other forms of investing. And, since the peer-to-peer lending world has experienced, I call it the great clean out, where we lost several bad companies to various different things. But since that has happened, there just isn't as much to really discuss. And I feel like within peer-to-peer lending now, the companies that are operating and the good ones are fairly quiet when it comes to things like news. And if you take a company like LoanPad, for instance, you just kind of tick along. A lot of companies are doing the same now. So whilst I still do solely focus not only on peer-to-peer lending, I still cover peer-to-peer lending because I still enjoy looking at it and I still invest through some of the companies myself. But I do choose to look at other things too, and I hope that you can appreciate that and enjoy it too, because I think these topics that we cover are things that all of us are facing in our lives. And today will be no different. We're going to look at a couple of really interesting emails I got over the last month about car purchasing and stock picking, which I thought they were just really great emails. So again, if you have an email, something you want to ask or a question, send it to help@financialthing.com. And who knows, maybe your email question will show up right here. Anyways, a quick shout out to everybody. Actually, let's do some housekeeping and pop this right here. I totally forgot to update this, but this is going to be updated next time I show it to you. But now you can earn I believe the new rate is 10.25% gross per annum is the offer at the moment, with over £330 million of property-backed investments made since 2016. Zero investor losses to date. That is Cufflink, the sponsor of the Financial Thing YouTube channel. And of course, the Harley Cam. She is having a good snooze. today. But check out Cufflink if you don't have an account. Just remember that your capital is at risk. Please don't invest unless you're prepared to lose money. You might not lose money with Cufflink, but within peer-to-peer lending, there is always a chance. Trust me, I've lost money, and it happens. Remember, the interest rates can change, and offers can change. So check the website for the latest offer. You can sign up at join.cufflink.com/financial-thing. Thank you to Cufflink for being a proud sponsor of this channel. Quick shout out to everybody on the stream who's watching. Please hit that thumbs up if you can. Maybe it takes a second. Helps the stream out a lot. Hate to ask, having to do that feels so ridiculous, but you know, you have to do it. Peter Vince is here, of course, in moist and damp Leatherhead. I wish I could show you how beautiful blue skies outside, but the camera's fixed to the monitors, so I can't do that. But it is very sunny here. Jimbo Naughty is here. Mr. Darren in a moist Cambridge. Evening to you, Colin Perry, in the not-so-sunny Peak District. But I tell you what, if I was going to be in a not-so-sunny place, the Peak District is definitely one of the places that I would choose to be. Robert Pates is here, back in Crete for a while. It's not a bad place to be back to. Mike Powell's here. Evening from Kenilworth. Paul Bagworth Allen is here in a dullish Worcestershire. Dave from very wet Staffordshire, just back from a drive in the car. One of the roads was more like a river. We're going to talk about cars, actually, funny enough, today. Chimpo Naughty, live stream with Natalie Weeks from Cufflink was good. Well done, Lawrence. Thank you. Well, thank you, Darren. Glad you enjoyed it. It's not easy, you know. I tell you, I spent so much time getting information together for these streams. They do take a lot of time, and it's not easy trying to get these guests scheduled. Not everybody wants to do it, believe it or not. Some people are reluctant to come on camera and put everything out there, but the companies that we do have come on stream, we're super grateful that they do choose to do that. This is really the only place that I've found on the internet where you can hear directly from the people running these companies live. So I hope to continue doing that. If there is somebody that you would like me to get on, I will attempt to do that. I know everybody's saying, Stuart Law, Stuart Law, Stuart Law. I've reached out to him. I just don't think he's going to come and do it because Bray doesn't want to face the wrath of what is probably going to face. So I'll keep trying, though. Aki Chap is here in Accrington. John Day in Nottingham. Stephen Hale in Nottingham. It's the two Nottingham guys. They always comment, or usually one after another. Annabelle is here. Hola. And Mike Powell. Anyways. Not sure about the flexible. Did I mention flexible? Anyways, let's get right into things. My brain is going 1,000 miles a minute today. I wasn't really sure what I was going to talk about, but let's just crack into. Let's have a look at loan pad statistics. I haven't done that in a couple of weeks. I wanted to see where they're at. Here we go. Let's zoom in a little bit for those hard of seeing. Total loan value, £173 million. Total loan pad loans, 90,334,000. Average loan size, 416,288. We got 217 live loans. Average loan to value, 41%. That has not changed much over the last few months. Total security value, 219 million. These are really, really good numbers. Oh my God, I have to tell you, I think something is actually possessed in my office. I keep hearing these noises. I don't know if you can hear that. Now it's stopped. Anyway, I don't know if there's wasps in the wall or in the roof, but it's freaking me out. Anyway, let's get back to it. Sorry about that. 17 lending partners, estimated time to invest and estimated time to sell was actually less than 1 day. Nothing in the ICF is being used, so nothing problematic that I can tell. And 661 loan pad loans since inception. Look at that. £250 million of loan pad loans since inception, and 444 total loans repaid. Loan pad just continues to really tick along not much to report. 6.5% in the 60-day access and 5.5% in the regular access account. Good job to you, Cufflink, for continuing on the way that you are. Landlord Invest reveals that more than 50% of B and C rated loans have been paid on time. So for anybody is wondering about peer-to-peer lending and these property-backed lending loans and why they take a while to repay, they tend to go past due. Look at that. That just goes to show Landlord Invest is no different. They reveal more than 50% of B and C rated loans have been paid on time, which on the other flip side of that shows that 50% haven't. Again, very, very common in the property-backed lending world. Landlord Investors published the performance of its loans by risk rating, revealing that more than 50% of B and C rated loans were paid either on time or early. The analysis includes all loans originated on the peer-to-peer property lending platform since it began trading in 2017. A-rated loans have no history of any issue and 100% record of being repaid on time. However, the majority of LendInvest lending takes place between the B and C categories, with some also in the D category. Loans with the risk rating D experience some sort of issue 92.9% of the time and were only repaid on time in 18.2% of cases, much less than the B and C rating risks, which were prepaid 51.3% and 55.6% of the time, respectively. I mean, that makes a lot of sense that obviously a D-rated risk loan, a lot more risky than a B on paper, so it goes kind of logically that you would have a bigger percent of the time when those are not paid on time. It's possible, this is a quote, it's possible that the Landlord Invest platform lenders don't mind that some loans are repaid in full after their original maturity date, as they still receive interest during this time. And in some cases, a part of that interest may be paid at a higher rate due to penalty interest charged to temporarily delinquent borrowers. That's what the platform said. Landlord Invest noted that loans in default have either gone on to be repaid in full or are currently still being dealt with. It said that at the time of writing that there has been no capital lost on any platform loans. A large percentage of loans in categories B, C, and D have been extended at least once. In some cases, these extensions were between 6 and 12 months, often in conjunction with partial capital payments in response to the special economic circumstances such as the pandemic. Other extensions might have been made where there were no particular issues with the loan. For example, a borrower with a performing loan might contact the platform prior to maturity to let it know about delays in refinancing or sale of a security property. Yeah, it's quite difficult to refinance a property. It doesn't move quickly. If you go to a high street bank, things tend to really drag out. So it's very, very normal that these property loans do get extended, and Landlord Invest, which by the way is a pretty smaller platform in the grand scheme of things. I think they have about an 18 million pound loan book, something like that. Let's look here. Yeah, you can see there. It's Landlord Invest statistics, 18.4 million pound loan book. So yeah, not a huge platform, but you can see their average rate of interest paid to lenders is 10.46%, with an average loan to value of 63.45%. There he is, Narinder. He's going to be back too, by the way, on the stream. I believe in June we're going to kind of do a mid-year catch-up with him to see how Cufflink is doing, but here's a very nice photo, that's for sure. Cufflink has been recognized as one of the best places to work. This was pretty cool. Cufflink has been named by the Sunday Times as one of the UK's best places to work in 2024. Cufflink is one of a select number of small UK-based companies to make the Sunday Times' shortlist. The newspaper defines a small business as having 10 to 49 employees. Cufflink was recognized for its investment in both its employees and the local community. The Times paid tribute to the creation of a charitable organization that helps young people and others in the area, and praised the company's commitment to encouraging staff in their individual career development. Dorinda said, people and culture create the essence of any business, which is why we focus on the happiness of our team. The Sunday Times analyzed more than 70,000 UK-based companies using an employee engagement service or survey, which was developed by behavioral scientists. The survey asked questions regarding employee well-being, job satisfaction, etc. Laura Hetherington, Chief of Staff and Operations at Cufflink, said the company is actively seeking new talent to join the team. So there you go. If you're looking for a job, Cufflink is hiring. Our success is a result of the effort our team puts in every day, says Hetherington. We're immensely proud of their dedication and commitment. So really cool. I actually wanted to go to the Times' website and look at this actual list, but somebody over there on the web design department has not programmed this website correctly. And when you click on the small business list, it either just tends to get stuck on this pink page, and when it does eventually come up, it was defaulting to the medium-sized business list, which Hyundai also was on that medium-sized list, but I've just had absolutely no luck getting this website to show me Cufflink's name. You can see here, you can see it defaults to medium organizations, even though I've been clicking on the small business page. But congrats to Cufflink for making that list. That's pretty cool. And then in other Cufflink news, a lot of Cufflink tonight. Cufflink reintroduces mezzanine and second charge loans. Cufflink has reintroduced a suite of mezzanine and second charge loans in response to growing demand for property finance. They are now offering second charge loans with a loan-to-value of up to 80%. It also has debuted an auto valuation model, or aka AVM, which can deliver loans of up to £500,000 with a maximum loan-to-value of 70%. Desktop valuations are available on loans of up to £600,000 with a loan-to-value of 80%. I'm not exactly sure what this line here means. Desktop valuations are available on loans. I don't know if that means that lenders will be able to look at a desktop valuation on a second charge loan. As you know, I've never been a fan of second charge loans. I don't think they pay enough interest to make the risk worthwhile, especially when you're talking about having a loan to value of up to 80% on a peer-to-peer platform. And you know I'm a big fan of Cufflink, but I'm not a big fan of second charge loans. I don't care what company it is that's offering. And if you offer me something like 20%, 18% interest, then I'll start to have a look at it. But usually these things are, 11%, 12%. I just don't think they're really worth the extra risk, in my opinion. But that's obviously for you to decide. Yeah, I'm not really sure, again, what this desktop valuations are available on loans of up to £600,000 means. And I also don't understand whether this auto valuation model is something that's just spitting out a value, or actually are they getting the property's value properly? I don't really know what that means, but it does say here, this is Paul Orger. He's the head of originations. He said that the new product offerings and platform updates have been made in response to demand from its borrower community. So that means that people that are trying to borrow money are looking for second charge lending. They're probably not going to get that from a high street bank, so they have to turn to alternative finance sources like Cufflink and other peer-to-peer platforms to do so. Paul said, in order to assist our borrowers and contribute to meeting the current housing demand, we've reintroduced mezzanine and second charge loans and improved our AVM, auto valuation model criteria, says Paul. This follows a comprehensive analysis of our loan performance and general property market data. As part of an overall enhancement of its product range, Cufflink is also offering expedited legals through its title indemnity insurance scheme for deals that are time sensitive. That's really interesting, this title indemnity insurance scheme. Funny that popped up. I've been looking at something like that myself for a property deal I'm trying to get over the fence here in the UK that's been dragging on for a while. So it's good that Cufflink offers something like that, because things can really get stuck in legals. I've been experiencing that for the last 8 months. Something, a property ground lease that's stuck in legals because of a title issue. So it's good that Cufflink is utilizing that. We had the Blend Property Pulse newsletter that came out. They always got good information in here about the housing market, which they are always keeping an eye on because it's part of what they do. Interest rates were held at 5.25% for the 6th consecutive time by the Bank of England this week. Not to say I told you so, but I did tell that I didn't think that interest rates were going to get cut because I think inflation is still sticky. So we'll see what happens at the next announcement. People are saying that they believe there'll be a second, at least 2 rate cuts this year. I'm not so sure, and I think they'll be pretty small if they do come. Overall, a drop in the UK interest rates by August 1st, almost fully priced in by markets currently. This view comes as UK inflation has continued to undershoot expectations. It dipped from 4% in January to 3.2% in March. Just remember, too, those inflation rate numbers means that things have gotten 3.2% more expensive this year than last March. So it still means that inflation is still an issue. I mean, those numbers are designed to look like there's not that much of a problem. But if you think about January of 2024, that inflation went up 4% from January 2023, the same month. That's a pretty large amount. And I think the 3% is going to be the new inflation norm. Meanwhile, an early spring housing activity boost has been slowed by rising mortgage rates while lenders continue to notch up rates. According to the National House Price Index, UK house prices fell by 0.4% in April. By the way, that is a really small amount. On a £300,000 house, 0.4% price fall is £1,200, so not a huge amount. UK house prices fell by 0.4% in April, which resulted in a slowing of the annual house price growth rate to 0.6% from plus 1.6% in March. So things are still upticking on house prices after they have actually fallen over, I think, the last few months. But there is still plenty of transactions happening on the market. Volumes edged up 1% in March from 83,040 in February to 84,200, but remained 6% down on 2023 volumes. So that means that obviously the housing market is being affected by these high interest rates. You see by the amount of transactions that are occurring. You can also see here that Blend put out this graph of the average UK house price source of nationwide house price index. You see down here, just 10 years ago, the average price of a house in the UK was looks like about £184,000. Peaking right here in the middle of 2022 to 270,000. So in 10 years, the average has gone up 100K. That's a big jump. You're talking about almost 70%, 80%, big time. Now you can see this is the annual percentage change in house prices. You can see the values dipped here, January, February of 2023, all the way down to about 6% in August 2023, and they've come back up since then. So yeah, good stuff that Blend has. I recommend definitely reading these. If you do get them, they show good insights into the UK property market. And why do you care? Because all of the peer-to-peer lending companies that you're getting your loans through are, most of them, doing property-backed lending, except for maybe Unbolted and a few other ones. So that's why you should care about this data, because it's going to affect the types of loans that they write and the amount of loans. I decided to go to our good friend Mouse in the Courtroom, who covers courtroom cases that are going on. He actually goes there and covers what's going on. So he likes to cover peer-to-peer lending. He has some interesting articles about the different companies that have experienced issues like Lendy and Collateral Funding Secure and the House Crowd. he has an interest. By the way, go support Daniel over there if you don't, because this guy's doing everything on donation base, where I get to sit here in front of a computer. He is actually going out in his car, going to the courtroom, sitting there taking notes, putting out reports, and I think it's really good stuff. So if you haven't, go check out mouseinthecourtroom.wordpress.com and support Daniel. He's doing really good work over there. This is a report that came out that says Lendy, 20% of borrowers failed credit policy checks but were still given loans. This was a confidential report that Daniel wrote about on here. I think this is just crazy. Let me find this. Here we go. A review of the Lendy loan book by insolvency experts Duff and Phelps, which is now Kroll, published in February 2018, shortly after the FCA found vital failures, has revealed a smorgasbord of weaknesses of the now insolvent peer-to-peer lending firm, that's Lendy, with members of the public set to lose millions. That's us. The confidential document, which says it must not be made available, copied, or otherwise quoted or referred to in any way, is being exclusively reported by Mouse in the Court. It's part of our ongoing investigation into the FCA's role. I thought it was okay to talk about this because it's out here in the public domain on this website. It's not behind a paywall or anything like that. Yeah, so basically what the report is saying is that Lendy wrote loans to people that should not have been able to access loans. The 29-page report was produced by Duff and Phelps, now known as Kroll, dated 16th of February 2018. 5 months after the date of this report, the FCA gave the firm the ultimate seal of approval in the full form of authorization. So despite this report being in existence, the FCA still gave Lendy full authorization. Lord Miners, the former city minister, is quoted in the Financial Times as having said that the FCA's authorization of Lendy gave it a sense of regulatory approval and endorsement which encouraged people to feel that they had been vetted. 15 months after the date of this damning report, the FCA pulled the plug on the platform. At the date of collapse, the loan book had total value of £152 million. Wow. So not good. Also, the findings in the report, there was poor record keeping. They were told Lendy used Dropbox, that's a website, to store its lending files centrally. The content of the email folders with the lending file is reliant on individual staff sweeping up emails from their individual email accounts and storing them on Dropbox. Very inefficient. From the status of many of the review files, it was evidence that information had been not kept routinely. As a result of emails, correspondence not being up to date and unstructured meant that understanding the chronology of events on a file was challenging. I mean, you can imagine trying to go through as an administrator through the mess that was Lendy and trying to consolidate all of those hundreds of emails that different staff members had and trying to figure out exactly what happened. I mean, what a mess, especially if the records were not kept correctly, which obviously they weren't. Findings on onboarding checks. Onboarding checks completed by Lendy was said to consist of an NCI check where the borrower is interviewed by a third-party field agent and 2 credit reference checks. In a rather startling admission, Lendy was said to have informed Kroll, or Duff and Phelps, that it was not until September 2016 that NCI reports and credit checks were routinely completed in advance of the loan being drawn down. This is shown by the 100% in the no column for 2015. This meant only after the money had been sent, the checks were done. So that means that Lendy was sending money to people that they had approved, but they hadn't done any checks on. So that, I mean, no surprise, right, that the company completely imploded. We're told that in one case, loans were approved for an existing borrower who has an active bankruptcy order. Get your head around that. Can you get your head around that? one of the borrowers had an active bankruptcy order going on, and Lendy still gave them money. Under presentation of loans, we're told that under FCA rules, Lendy is required to provide its investors and potential investors with clear, fair, and not misleading information about the loans promoted on its portal. In the files that were reviewed, borrowers had been described as experienced, where information on file indicated they had limited or no experience in projects of that nature or scale. It was not clear whether the borrower was an individual or a company and what type of company it was. Adverse credit data would have ordinarily put the borrower outside of the scope of Lendy's credit policy. The report says that in 31.7% of the 82 lending files, the description of the borrower does not reflect the content. Findings: application of credit policy. Kroll says they had identified 17 lending files in their review where loans appeared to fall outside the parameters of lending credit policy, and an exception could not be identified on the file. Those 5 lending files where the borrower had adverse credit data, 4 lending files where the loans appeared to exceed the maximum loan-to-value parameters, 3 cases where the loans were against property outside of the geographical parameters for Scotland, 2 files where the loan exceeded the maximum loan amounts, 2 files where we did not believe the borrower would pass a reputation check, and 1 file where the purpose of the loan appeared to be in breach of planning permission. Just a bunch of lies. Obviously, Lendy doing things they shouldn't have been doing. And it just really goes on and on and on about this mess of a situation over at Lendy. If you want to read that, go over to the Mouse in the Court room.wordpress.com. You can read all about what Daniel Fine out about that report. Pretty sickening. We put a lot of, I would say, blind trust into information that was given to us from Lendy that was absolutely, most of it was just all fluff. And I hope that I hope justice will be served when it comes to these guys and what they've done. They basically just hoodwinked people and taken money, and what they did was, in my opinion, just write as many loans as they could to take the fees on those loans. I remember one year, I'm sure I'll get corrected on this amount, but I think Lendy made something like £9 million in profit from fees that they were writing on new loans. And it's obvious to see why. The more loans that Lendy wrote, the more money they could get in on underwriting fees. So pretty sick. Not nice, Lendy, what you did. Kind of sad that I had him on this stream at the time. But, it is what it is. Let's see what else we got here. This is the Unbolted case, too, that Daniel wrote about. Unbolted lent money to a solicitor, and that was years and years and years ago. There he is right there. This guy claims that the Mouse in the Court man, Daniel, assaulted him outside the courtroom. Sounds a little off the wall to me. I don't think Daniel would do that, but who knows? Unbolted lends money to the solicitor, and then he ends up suing Unbolted over the money that he owes to the company. Quick tip out there: if you're a peer-to-peer lender, sorry, this is the guy right here. His name is Andrew Milne. Not a good look for you, Andrew, but he battled Unbolted in court for years, and then the court ordered that he did not have to pay his court case costs. Quick tip to a peer-to-peer lending company out there: do not lend money to solicitors, because if something goes wrong, that solicitor, if he goes to court, all he has to do is pay in the form of time. But if you're a peer-to-peer lending company, you need to defend yourself against the solicitor. You're going to have to pay for that. And the legal costs that came along with defending this lawsuit that went on for years were really expensive. So you have to be very careful. You don't lend money to a solicitor, because if anything goes upside down, he's going to be able to defend himself most likely, and all he has is time costs and very little financial So just remember that. Unbolted eventually settled that litigation. We don't know what the terms of that are, but they probably just got sick of seeing this guy in court going on since 2016, right? And then he launched a claim in 2019. So this has been going on for 5 years, this lawsuit situation. He took out a series of loans in 2016, so that was 8 years ago. So it just shows you how long things drag on for, and eventually Bolton just end up settling this case. They just didn't want to deal with it. Anyone probably didn't want to go to court and continue on that path. So it is what it is. Don't lend money to solicitors. Let's take a look at the Trading 212 platform. Well, a couple of changes. Number one, the portfolio balance right now is 19,684. This portfolio seems to just keep yo-yoing around in between 20,200 and back down to 19,600 today. You'll notice Alibaba, our Chinese friend, is gone. Decided to pull the plug on that. And we have a new position here, NVIDIA. This is a very degenerate play. Do not copy this. I am a degenerate stock picker. A lot of what I do sometimes makes no sense. However, on May 20th, NVIDIA will be having an earnings call where I believe in my heart they're going to post really good results, and I think the stock price will go in the green. Been bouncing around a little bit. I plan on adding to this position. I just opened it today. We'll likely add more tomorrow. I wasn't sure what the price was going to do, so I thought I would cost average it out, maybe add a little bit more on Monday. I think when is the earnings? 20th, so yeah, I guess we'll have to add tomorrow because Monday may be too late. And we're going to just take a degenerative shot at this NVIDIA position. Right now, holding a bit of cash, 9,980, which is getting daily interest. Coinbase has taken a bit of a fall back to $202, down 8% today. I'm not really sure why, because Bitcoin has been performing pretty well. Went over 66,000 US dollars today, so not quite sure why Coinbase's stock is down 8%. That doesn't make a lot of sense. I know Bitcoin's retracted a little bit in its price, but Creative Realities has really, again, been yo-yoing out, up and down. So not really much happening there. We're up about 2%. Coinbase are up 28%. So we've seen a big fallback in the last months, where we're up here at almost $240. So we've lost 20% back. Hence, you see why this is looking a little funky with Coinbase. I thought I might have liquidated some of that. Let me see if I didn't. I'll show you the Alibaba also. So we bought more on May 13th. So added to that position £1,000 at 203 US dollars. So I thought that was actually a pretty good entry point in the low 200s. And we had sold here on April 16th at $209. So a little bit of a difference there. Not much, but at a profit. So, and then if I go to the history, I'll show you the Alibaba. Where is the history? Where did it go? They've changed things. It's a little tricky trying to find things. I was struggling trying to figure out how to log off this website, and I finally figured out is this circle right here. It doesn't tell you how to log off, but they've moved things around, and now if you don't scroll down, you'll miss some of the other options that they have in there. So a bit of a change on the UI, but let's see, Coinbase. Let's see when we liquidated the Baba. Here we go, 6th of May. Sold all of the Baba position for a loss of 214. They just, I don't know. I just was doing some research. They had a poor earnings call I think this stock right now is about, I don't know, 88. I just didn't have much faith that that stock was really going to move much further. I think the thing about stocks is if you're trying to do some degenerate trading like this, yeah, it's at $86 right now. You want to move into the fast-moving positions. This is not really necessarily a long hold situation. Like this Creative Realities is a fast-moving stock. You can see it go up and down 10% in a single day. Yeah, so I'm always trying to move with the stocks that I think are going to move within, say, 3 or 4 months, maybe sooner. But I did add to the Creative Realities position a couple of weeks ago. Getting very close to wanting to get rid of this Rivian position too. Not really feeling like this is performing well at all, and maybe time just to cut the losses. Because also when you're doing this type of shorter term buying, you want to think, well, what can I do? Yes, I'm down 900 pounds on this, which is 33%. Number one, I could take a tax loss on the 908, but also what can I do with this 1,800 pounds while it's sitting there not really moving and it's sat in the red? Could I move into one of these other faster moving positions to make up for that loss? That's a possibility. So that is what's going on. And today was a big day for the S&P 500 because S&P actually hit an all-time historical high. So imagine that. Look at this. Look at where the S&P was in 1922, 7.06. Isn't that crazy? So 102 years later, now 5310. So a big day for the S&P 500. Good for trackers. And yeah, it was a good day for the S&P. It was very monumental. A little bit scary as to what happens next. We're still waiting for this possible fallout, but it hasn't happened yet. Let's see what we got here. Okay. Couple of emails that we got. This is from Sally McCann. Lawrence, first off, I tune into your live stream. Yeah, it is a bit of a live stream sometimes. On catch up early every week. Thank you for everything you do. I know it can't be easy. It's really not. Thank you for recognizing that. Live streaming stuff is not easy. Got many things you have to research and keep people happy. But anyway, my husband and I are currently in conflict. Oh no. Sally, don't be in conflict with your husband. I want to only invest in index track as well. He likes the thrill of stock picking. So, some typos in here. There's been this history of people really messing up the typos and the grammar on these emails, but I try to figure out what they're trying to say. It says, I want to only invest in index trackers as well. He likes the thrill of stock picking. Trust me, I know that well. I know you show your trading 212 portfolio and it has done relatively well. However, do you have any other portfolios that you've tried stock picking on? If so, can you tell me how they have performed? I'd like to show him the results if possible. Best wishes, Sally McM. Oh dear. Well, it's a really good email, Sally. And I guess I'm going to tell on myself today that I do have another stock picking portfolio, and I'm going to show you the results of how that has done over the last 3 years. This is a good tweet from Lindsay Stamp in the US. It said, a few years ago, as an individual stock investor, I don't know why I thought I could beat the market, but I did. I bought penny stocks, day traded options, held individual names instead of index trackers and funds. Let me tell you something. There was nothing more frustrating than watching my stocks go down or stay flat. When the S&P 500 was ripping to new highs, I very quickly realized how hard it is to be a stock picker and beat the market. People dedicated their lives to this and do it full time, and I was doing it on the side as a hobby and thought I could keep up. It's been 10 times less stressful and way more profitable buying the index. It took me humbling myself and putting my ego to the side to come to that conclusion. Imagine looking at, this portfolio here, which is not huge by some people's standards. This is a decent amount of money for me. That's the price of a car. But you looking at something like Rivian down 32% going, wow, the S&P 500 now is at massive highs, right? let's look at the 1 year or even just the year to date. 11.92% in 1 year, 28.82% in the green. This is the S&P 500, and I'm looking at my Rivian going, shoot, 32% in the red. That's almost a 60% swing. Stock picking is not glorious sometimes and can lead to really severe losses, which is why you probably should never do this. But I really like that. I like that email quote. But just to go back to this, Sally, I will show you. This is my stock trading portfolio that I have aside of the Trading 212. I'm not going to show you numbers because it's personal and I really don't want to show you that. But I'll show you the year to date on how this is performing versus just say the S&P 500. My account, 4.5%. In the plus, with the S&P is 10.78%. That's year to date. Go to the 1 year. Mine is at 11.95%, which is really good for a year. I mean, you'd be happy, right, to get 11.95% in the plus on your stock account. But look at the S&P, 28.12% in the red. So this little stock trading thing has cost me 16%. And look at the NASDAQ, 34.88%. How about this? 3 years, 6.8% annually versus S&P 500, 24.84%. Sorry, not annual, but total over the 3 years, 24.84%, 6.8% for my stock trading portfolio. Not good results. Again, thankfully I do have index trackers for the majority of everything I do invest, but word to the wise out there, and Sally, you could show those numbers to your husband. This is real life percentages that I have experienced myself from just stupidity, and there's been times where it's been good. You know, I went through that period in 2001, I think it was 2002, where the oil stocks really took off, and this Trading 212 portfolio, it started out as 5,500 pounds, so it's done well. But over the long run, guaranteed that I will lose to the indexes over the long run. 100% sure of that. I can be 100% sure of that. Why do I do this? You know, I'm a human being. I like the challenge of trading and buying things, and index trackers are boring, but they're the way to go. 100%. I do. Probably 85-90% of everything I do is in an index tracker. 10 to 15% doing this kind of stupidity. Stay away from it. It's really just not worth it. This is the way to go. Put it in the S&P. Put it in an index tracker. Put it in the Vanguard tracker, whether you want global or US. I keep saying this over and over again because I keep getting these emails every week about stock picking and why I should try stock picking. Just don't do it. It's not worth it. This can really mess up your retirement. This is a great quote from Peter Lynch. Whatever method you use to pick stocks, your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. It isn't the head but the stomach that determines the fate of the stock picker. Such a good point. Thank you, Peter. I'm not a big fan of you, but you're exactly right. A lot of stock moving and selling and buying comes from the stomach. With that feeling as if, number one, you're missing out. Number two, the stock's going to go lower. It's about the gut. It's not about the head. The head looks at fundamentals and smart numbers. The gut makes decisions based on the way that one feels. That's really detrimental to a stock picker. I thought this was really interesting. Warren Buffett's portfolio came out. If you ever wondered what Mr. Warren Buffett, one of the richest men in the world, is investing in, you could see it on the SEC's website. I thought I would snapshot it off for you. This is Q1 of 2024. He's got $331 billion US dollars of stocks. How crazy is that? 135 billion in Apple. That's 40% of his portfolio. Talking about putting a lot of eggs into an Apple basket. Yeah, he also reduced that by 12.83%, but he's got 131 billion of Apple stock. And then Bank of America, American Express, Coke, Chevron, they're all blue chips. I don't really see much in here that is more risky. But what I found really interesting about this list, well, number one, he's got down here Sirius XM satellite radio, which that was interesting. But he also down here at the very bottom has Vanguard S&P 500 ETF, 20,670,000, which is small of his entire, but he still has 0.01% of an index tracker ETF, and also the SPY, which is basically buying the entire S&P 500. He's got about the same $20.6 million of that in there. Also, I was looking at Bill Gates' portfolio, just curious what he had. He's got, again, a lot of blue chip, Coca-Cola, Walmart, FedEx, a couple of smaller things. But, yeah, this is weird to me. Carvana, which is a company that's been shedding money for a really long time. And then, of course, big holdings in Microsoft, which he sold off quite a bit of that recently. But look, he's 0.58% in the green. This is your typical stock picker's portfolio. You got some in the green, some in the red, more in the green, more in the red. Look, minus 13% here, minus 10% here. So he doesn't know anything more than what we know. Except for Carvana, which is up 37%, which is weird. But yeah, really interesting to look at their portfolios. And let's go to second email. This is talking about cars. Not peer-to-peer lending, but cars. Let's see here. Yeah. Hi, Lawrence. I know you mainly cover peer-to-peer lending. You seem like a savvy bloke. I thought I'd pose this question to you. Hopefully this makes it on stream. 6 months ago, I had a new job position making $42,500 per year. I currently have to commute to work about 50 miles daily in my old car. 2010 Honda with 42,000 miles on the blink, and it will cost $3,000 to fix it up. I have my eye on this cheeky BMW 2M Sport Series for $29,500, which I want to get a loan to pay for. I do not have any other debt. P.S. It has been a dream of mine to own a BMW since I was a child. I think I know your answer will be, but is this car purchase a good or bad idea in your opinion? Is it a really bad idea? Cheers, Darren. Well, the car business isn't, I would say, a problem. This is a piece of data from the 2023 year where it shows that now in the UK, 30.7% of cars on the road in the UK are more than 12 years old. The average used to be, I think, about 10 years, and that has really gone up a lot. A lot of that is because of car prices, which have absolutely gone through the roof. You can see here in the US, this is now a 16.8% of the first quarter of 2023. Car payments topped $1,000 a month. And the problem is that salaries are not really going up enough to make payments on these cars. Look at the median annual earnings for full-time employees in the UK. This is 2023. 34,963 is the average or median annual earnings. If you're in London, it would be a lot higher. But a lot of people are spending a lot of money on cars now. Your average price right now of a UK new car, if you're looking for one small, 19,000 to 25 grand. Imagine that, 25,000 for a new small car. That's crazy. Medium-sized car up to 28,000 is about the average, and 32,000 for a SUV. Prices have really gone up a lot. You can see in here how a price of a Ford Fiesta from almost 10 years ago has really doubled. It used to be $9,000 $995, and now in 2023 it's $19,350. A lot of people spending a lot of money on cars that they really cannot afford. All right, look at this. Also, you want to remember too that the car market is starting to really cool off. You can see how during the pandemic here, car prices really went sort of crazy, right? And now they've started to cool down here. So I think it's becoming a buyer's market for cars. And I think a lot of car dealerships have a lot of inventory sitting there that they cannot move because people do not want to pay that much money for a car. A lot of people don't have cash and they finance cars. As the email said, they wanted to finance it. And the answer to your question, really, Darren, is you think about how much you're going to pay towards that car. This is a calculator. If you borrow 25 grand, first of all, if that car's listed at 29,000 pounds, that's what it's listed at. By the time you pay fees on top of that, you're going to be probably 31 or 32,000 because they're never the same price as what they're listed for. But let's just say you borrowed 25 grand at about 6%. You're going to be paying 481 pounds a month. That's after your down payment on this vehicle. And you only make, in the mid 40s. If you made 100,000 or 200,000 pounds a year, I'd say, you know what, go for it. Enjoy yourself. But you have to look at the opportunity cost of putting this money into this car. Now, I know you said on your email that you have a car that has 42,000 miles that's going to require 3 grand's worth of work. But 481 pounds is going to be a lot of opportunity costs that you are going to miss. So if you put that into a compound interest calculator and you just invested that money instead. Now, I know you need a vehicle, but hear me out here. Let's say your payment's 500 pounds a month after all the fees, and you put that into, say, an index tracker, getting an average of 7% for the year, and you're going to put in 500 a month. Let's say you start with what your down payment was going to be, 3,000. Let's just look at those numbers up. You'd end up with 40,049 pounds after 5 years versus that car after 5 years that you spent 45 grand on is probably going to be worth 60% less. So you've bought a depreciating asset. Most cars are depreciating assets. Well, I would say liabilities. They're not really assets. I mean, they're assets because you need a car to get to work, but they're a liability because of how much they depreciate, especially now. Now, before, when prices were going crazy through the pandemic, cars were actually seen as an appreciating asset, but that is no longer the case. So think about the opportunity cost of purchasing this car for $29,000 on a loan that you're going to pay interest on. You're probably going to pay about 3 grand of interest or more, depending on fees. So after 5 years, you have 40 grand if you put in that 500 pounds a month. And who knows, if the stock market goes crazy and does 12% over the next 5 years, it could. You'd then be at 46,284. So what I think is a better idea for you, Darren, I know that BMW looked absolutely wonderful. Who wouldn't want to own a nice 2 Series? I'm a car guy. I mean, I love cars. I battle with the same problem all the time. I see new cars come out and I want a new car because they look so shiny and new and all the technology and the beautiful things. But at the end of the day, cars are not only depreciating liabilities, but they also depreciate on how much joy they give you. If you drive a new car for the first month or two, you're going to feel an immense level of joy. But as time goes on and that car gets older, your level of joy starts to ratchet down. So if I look at my 7-year-old, I have a 7-year-old Mazda 3. I remember the day I drove that thing home, I was just so happy. And that thing made me happy for about 3 months. And then I reversed into another car that was in my driveway, stupidly, because I had a backup camera and it didn't beep. And I didn't look at this behind me. And I crunched it. And that level of enjoyment that I got out of that car after that little accident, a few months after I'd owned it, I think it was 7 or 8 months, my enjoyment started to wane down. And now, when I get in that car 7 years later with 91,000 miles on it, I don't feel that same level of excitement or enjoyment. I would say it's probably 20% of where it was 7 years ago. So while it seems like that car is a dream, and well, it seems like that now. Point is, after a year or 2 years, you're just not going to feel that same level of joy anymore. I promise you that. I remember the first car that I ever bought was I think it was a 1989 Ford Mustang, and I'd always wanted this car, and I think the second day I got it, I was driving around on tires that didn't have much tread on them. I didn't know anything about cars. I just bought this car and thought everything would be okay. And I spun the car out and drove up a grass bank the second day that I owned it. And needless to say, after that point, my level of enjoyment of that car really started to decline month by month until 5 years later when I got rid of it. What I think is a better idea for you to do, Darren, and put your opinions in the chat. 42,000 miles on a car is really not that much. That's half of what my car is. And cars nowadays are actually pretty reliable, even from 10 years ago. I would take $3,000, put it in that car and fix it, do all the maintenance you need to do, and then save up your cash and buy a car for cash. Because honestly, if you have to finance a car, especially when it's 6%, 7% interest, I don't know what the rates are nowadays on secondhand cars. They're not that cheap. You're probably going to be paying 6 or 7, 8%. If you are having to do that, you probably can't afford that car. I personally believe paying cash for cars is the best way. Number one, you don't feel that guilt. If you buy a car and you're paying on it for 6 or 5 years, after year number 2 of making those monthly payments, you're starting to feel pretty crappy about making that payment every month when you're not getting the same amount of enjoyment out of the car. If you pay a car for cash, there's no attachment to it. You can get rid of it if you want to. And also you can use the money that you're making on that monthly payment to invest for your future, and actually hopefully that money will turn into more money because you're investing it in something that's appreciating versus putting money into something that is depreciating. So I would take that money, I'd take $3,000, fix the car up, and just drive it for another couple of years and just save your money. Hopefully your income will increase as time goes on, and you'll have more money in your pocket. And I think in a couple of years you'll be happy about that. And believe me, I am just as attached to cars as the next guy. I would love to go out and get a brand new car, a nice BMW 3 Series, 33i. Yes, please. But also with the BMW too, you're going to have maintenance. It's going to need more maintenance than probably a cheaper car will, a Honda or a Toyota. So you have to think about that stuff. Your insurance is likely to be a little bit more. And here in the U.S., we have to put a different type of petrol in a premium car than we do in say, my Mazda, which takes regular petrol, whereas a BMW takes premium. I think it's about $1 more a gallon, so petrol costs more. Just think about all of these things and think about it based on what you earn, and make a smart decision. That would be what I would do. So you asked, is it a bad idea? Yes, I think it is a bad idea. You haven't really told me too much about your financial situation, aside that you don't have any debt, which is good, but you didn't tell me how much you would be paying on the loan interest, so it's not always easy to give you an answer. But in my opinion, don't do it. Stick with your Honda, and I think you'd be a happy guy. A little bit of Bitcoin news. Right now you can see the price, $64,946. So we've had a good week. I would see here, look, 62,000, 61,000 2 days ago. So we've had almost a 8-9% jump. So things are going well. I think that there's a bit of good news today that came out in the Bitcoin magazine, which is saying the U.S. legislation is going to overturn an SEC ruling preventing highly regulated financial firms from custodying Bitcoin and crypto passes the Senate. So this is legislation where the Securities Exchange, blah, 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 SEC in the U.S. said that regulated financial firms could not hold Bitcoin as part of their ledger. So you know how Tesla has Bitcoin and they invested in it and they hold it as part of their books. Well, now this legislation saying that financial firms could not do that is being overturned. It could get vetoed by the president, but I would say that's very bullish news for Bitcoin, because that would mean that companies like JP Morgan, they could actually hold, not that Jamie Dimon would do it because he hates Bitcoin, but a company like that could hold Bitcoin as an asset on their balance sheet. That's pretty big news, I would say. We'll see if it makes it through. It's passed in the Senate. Yes, it could get vetoed. Now also, ARK shares, there's Kathy Wood, they've applied for spot Ethereum ETF. So we've got the Bitcoin ETF now in the US, and then the next one is going to be Ethereum, which is the second biggest cryptocurrency. Let's see where it stands right now. A little bit less than $3,000 right here, number 2, with a market cap of $354 billion. To get your head around that, that's $354 billion of market cap on Ethereum. So that's going to be the next ETF. I think that will be approved. It might take a while to do that, but all of the same characters that applied for Bitcoin ETFs, including Fidelity and BlackRock, will now go for this Ethereum ETF, which could possibly make these Ethereum prices rise up dramatically. We don't really know exactly what's going to happen, but if it does, I would say that's a pretty bullish piece of news. And then finally, this is not, I guess it is kind of financial, but a piece of news that is pretty near and dear to my heart. The ironic Mirage Hotel in Las Vegas is closing after 34 years. If you've ever been to Las Vegas, which I'm sure some of you have, I don't know, let me know. Have you been to Las Vegas? I've been to Las Vegas, I don't know, 25, 30 times out of my life, a lot. I think it's a pretty cool place. Not for everyone, but if you like a bit of a flutter at the tables, or you like going to see shows and going out to the desert, Vegas is a cool place. So the Mirage, you can see here the Beatles show Love is there, but they've got the famous volcano outside, but that hotel is going to be closing. Also, that hotel was shown in the Chevy Chase movie, Vegas Vacation, the National Lampoon's a really funny film. They're going to be turning this hotel into a Hard Rock casino and hotel. So I don't know if you've seen a picture of what the Hard Rock Hotel looks like in Florida. There's one in Tampa. There is also one in Hollywood, Florida, which looks like a big guitar. I'll show you a picture of it. That's a picture of the hotel right there. It looks like a guitar. So they're going to rebuild this guitar hotel in Las Vegas to where the Mirage Hotel used to be. And fun fact, that the Hard Rock empire was built by profits from one single casino in Tampa, Florida. So that was the original Hard Rock Seminole Indian Tribe Casino, and they were able to take all of the money that they were getting from people gambling at that hotel, and they bought the entire Hard Rock brand, including all of the hotels, all of the cafes, and everything in between, and they built this massive empire. So just goes to show you, if you ever go to a casino, remember that those buildings were built from your money. Yeah, gambling, be careful. So pretty cool that they're actually going to build that, but kind of sad that now that the Mirage Hotel is going to be no more. So I used to really love going to this hotel. There's something nostalgic about it. It was old school inside, smelt a little bit musty, but Pretty sad that in July that's going to be your last chance. So if you can get over to before July, I think it's July 17th, that place will be closed for 3 years. 3 years. So. Well, oh, my mouth. Oh, Lord, look at the time. It's 3:40. Went way overboard today, but let's see if you have any interesting comments. Don't look behind you. Oh, God. I'm still hearing this noise. I don't know if it's haunted in here. Lendy was the most profitable platform in the universe. I know. Crazy. Look at the fun you could have had this week with meme stops just because somebody tweeted. That was crazy what happened, yeah. I was looking at the Lexus LBX. Lovely economical car, but the price is just crazy, yeah. I was thinking about changing the Mazda out, and then I thought, what's the point? The car prices are just so high right now. I think what's going to happen, this glut of repossessed cars that's happening, do some research because there's a lot of repossessions in vehicles. I think those cars are going to get put on the open market and the prices are just going to really continue to fall. And there'll be some good car deals, I think, in the next year or two. We'll see. Got married in Las Vegas in 2000. Little white wedding chapel. No, Elvis wasn't there. Pretty cool. Well, I hope you enjoyed the stream today. It was a little bit different. Next week, don't forget, please, come back. Mike Bristow from Crowd Property will be here live. Bring your questions. We'll talk to him, see what's going on. Sorry the stream ran for so long today. I was planning on 50 minutes and done. Obviously, that didn't happen. But have a great weekend, everybody. Enjoy yourselves. Hopefully, the weather will be better. And say goodnight from little Harley. She's having a snooze. And we'll be back next week with Dave. I'm going to say Dave Dawson. Not Dave Dawson. Mike Bristow from Crowd Property. And that's all I got for you this time. Take care. See you next time. Bye.